Keith Meister is the founder and chief investment officer of Corvex Management. He is here with me at Post 9 for a CNBC exclusive interview. It's been a minute. Welcome back. It's good to see you.
Thanks, Scott. Great to be here.
Interesting day for you to be here. I mean, what is your general view of where we are right now?
So we're micro investors, but we believe we need to let the macro inform the micro. And last year was all about the move from QE to QT. And this year is going to be all about the move from interest rates being zero to some higher number. Over the last 6 weeks, the terminal rate for Fed funds has increased by 50 basis points, and the data that's come in has said that the Fed has more work to do. So my sense coming into the year is sort of unchanged. I thought it would be a choppy year, a year of dispersion. The markets repriced a lot last year, but this was going to be a tough year. I think we were all surprised by the move in January. I heard earlier in your show you were talking about positioning. That was a big contributor. The economy being stronger was a contributor. China reopening. Mike Wilson today talked about liquidity from stimulus in China, from yield curve control in Japan, from a weaker dollar. All these factors sort of drove equities up in the beginning of the year, but the fundamental backdrop did not change. And that fundamental backdrop is how much more work does the Fed have to do? The economy's strong, and if interest rates are higher, what are equities worth? And our general view at Corvex is it'll be a choppy year. If you think about the risk premium for equities, a week ago it got as low as 150 basis points. So the excess return you make in yield owning equities versus bonds. So it's not great asymmetry owning equities. With that said, there's always wonderful one-off opportunities. And my guess is this is a year in which people can create value by being good stock pickers, knowing businesses well, finding idiosyncratic events, trading around positions, taking advantage of short-term dislocations. The good news is there's not massive structural problems. The good news is the biggest companies in the market have a lot of self-help and trade at relatively reasonable valuations.
You're talking about like the mega cap tech names, for example, when you say self-help in terms of right-sizing their businesses. The question for those, and you've been involved in several of those throughout the years, is whether they've right-sized enough, whether their valuations have right-sized enough too.
Look, Silicon Valley has historically not been great cost cutters. However, everyone's gotten the message, and each company will do it differently. But my guess is what they have going for them is they have a lot more self-help than the average widget manufacturer that over the last 13 years of a good economy and lower for longer has probably optimized their business. So how do you make money owning an equity? You make money if you get multiple expansion.
Which we've had.
Which we've had, and we're probably not going to get from here. The risk premium point is our multiples are probably at peak levels. So multiples become a headwind. What is your tailwind? It's earnings growth. If the economy is slowing, how do you make 20% owning a stock if we all want to make 20%? You need 20% EPS growth. You're not going to get that from most status quo businesses unless they have levers to pull or one-off idiosyncratic events. So we're trying to manage a balanced portfolio that can find some GARP names that have that, some idiosyncratic event names that have that, and some old economy names that have that.